Essa jornada também começa com a presença da liderança global do nosso network. Liderança global que não apenas lidera o network, como concebeu, criou, originou o network de transfer price da PwC no mundo, de uma forma extremamente competente, eficiente, e aqui eu falo, claro, com humildade, mas com o reconhecimento daquilo que, como eu falei, segue sendo o maior network global de profissionais de preços de transferência. E essa pessoa, ela está aqui presente e é o meu grande amigo, Horacio Peña, a quem eu chamo no palco agora para a sua apresentação. Por favor, Horácio.
Muchas gracias, Durbal. Muito obrigado. Good morning. I identify myself as Horacio Peña. I'm a white Mexican middle-aged man dressed in blue today. And I'm thrilled to be here with you to talk about transfer pricing. I'm so happy to be in Sao Paulo again, actually first time after the pandemic. So it's very, very exciting to be there. Thank you so much, Durbal, for your very kind introduction, too kind introduction. I'm so excited to be with all my friends here and to see so many familiar faces over the years. So today, as Durbal said, my job this morning with you today is to try to frame a little bit. And I want to start from the very beginning because it's a little bit of a personal journey, as Durbal said, in terms of the evolution of the arm's length standard. So I want to start from the very beginning, trying to frame the rest of the discussion that we're going to have later on in the workshops and specific rules that we have in Brazil and the very specific co-creations that we'll have here in Brazil. I want to talk about the recent environment, the global environment, the recent trends that are impacting our businesses every day. Do a little bit of contrasting as an introduction only of the income tax law in Brazil and the arm's length standard from a practical perspective, how it's being implemented, and then hopefully we can take some key takeaways to frame the rest of the discussion later on for the rest of the day. So, a little bit of a personal journey. I was born and raised in Mexico City, and I didn't know anything about tax. And one day, there was a huge financial crisis. There was capital exchange controls, 100% inflation, and that was the day that I decided to study economics. And I was very interested in the relationship between government and markets. And I was also very interested about these financial crises. I studied economics and political science, and then I finished my studies in the United States. As you know, 1989 was the year the wall of Berlin came down, and 1990 was a really important year. That's when I graduated from my graduate school, finished. I went to work in Washington, D.C. In 1990 was the third industrial revolution started. It was Windows 1.1, the internet came out, supply chains began to be managed globally. 1991, the Soviet Union collapsed, and there was this huge change of evolving. Bill Clinton started enacting transfer pricing in the United States because there was a lot of companies that didn't pay taxes in the United States. There were the first court cases. So I started working in transfer pricing court cases back in the early 90s. 1993, I went to Mexico and started working on some of the first transfer pricing studies in Mexico. The Mexican government was about to go into NAFTA, so not surprisingly, Canada, Mexico, United States were the first countries to enact the arm's length standard. We did the first APA in Mexico, and after that, we developed a number of advanced pricing rulings for all the manufacturing sector. There were 3,000 taxpayers, and we did 1,700 rulings in Mexico during those years. 1997, 1998, we went to Argentina. We started the practice in Argentina with Mercosur, and we started, I remember coming to Brazil in 1996, and we started doing the first transfer pricing studies in those years. And there was a very interesting transactions in Mercosur with Argentina, Brazil, Europe, and the rest of the world. The transfer pricing rules quickly spread through many, many countries, and in the 2000s, we have the United Nations starting providing advice to many emerging markets. The OECD wanted to, with a mission to become more comprehensive, to include emerging markets. South Africa, China, India, Brazil were all participating in those dialogues during those years. I was lucky enough to participate in the UN Expert Committee on the work of the United Nations Transfer Pricing Manual. Brazil was endorsing the BEPS package, the Based Erosion Profit Shifting Program for the OECD. And Brazil played a very important role on the G20 in a lot of these discussions around BEPS. The evolution moved out very quickly. Obviously, there's been ongoing debate and discussion of international tax reform for many years. And finally, last year, the G20 finance ministers agreed. 130 countries came together to create a new international tax system as part of the Pillar 1 and Pillar 2 framework. And most recently, of course, we know Brazil has made the commitment to adopt the arm's length standard. So this, needless to say, has tremendous repercussions for our businesses and for our functions in the tax department. Fast forward to 2017, the fourth industrial revolution starts. So we have a tremendous amount of data, artificial intelligence, digital model, the emerging 8 technologies. And what we see is that there's a tremendous demand for data and real-time information. Tax administrations all around the world start digitizing in a very fast way, using bots to conduct examinations, digitizing all of economy. Brazil has been a leader already in technology, in tax for a very long time. And what we see is that the world is actually deglobalizing. So the actual trade flows for goods and services have declined, but there's a different type of globalization, and now it's data related, right? So the data flows, it has been explosive, and therefore the need to tax these data flows and these digital models have changed in a very radical way. And as we know, all of taxes are local. So just because we have this international cooperation, the actual implementation of these things have changed. And then COVID came, and COVID hit us, and it was remarkable just to think about there's only been 3 years since the pandemic, and look what the world has changed. Most people would say that probably from a technology, digital perspective, we advanced 8 years in literally in 9 months, and how radical the change occurred. And most companies and even most governments have gone through this, what I call this 5R framework of change. The first thing was to restart the operations. Operations had stalled, had stopped, and revenue stopped for many companies. So basically revenue stopped, we have to reactivate revenues. People were not working, we have to bring them back in. We have to protect our people, we have to protect our infrastructure, and the immediate priority was business continuity. Quickly after that, companies started working on repairing the supply chains, repairing the data processes. A lot of things have broken. A lot of companies in different industries were at different level of maturity with respect to the technology curve and resiliency. And then finally, we go into a third stage of rethinking our people, our technology, and our processes around how we're going to reorganize ourselves. And quite frankly, I think most businesses and governments around the world were surprised that yes, this technology works, this data really works. We can create these models pretty fast. We're pretty surprised how quickly we can do these things. And at the same time, there was a realization that we had invested 30 years on super efficient supply chains, and now we have to shift and we have to create strong, resilient supply chains, which meant multiple sourcing across the world in many different things, diversity of sourcing, of everything. At the same time, we had 2021 and 2021, the stock market was very high. We had record deals, we had record IPOs, and there was this movement around enterprise value creation. And companies really start looking at this and saying, wow, it's an amazing opportunity to reconfigure our business models. So if you're in a sales, you're running a sales activity for services and you want to sell that business, well, maybe you're going to get a multiple of 2 or 1. But if you're creating a digital model and it's a SaaS model, software as a service, and you're going to create tremendous high margins, you create new channels, you can do a lot more business, business to business, business to consumer, create enterprise value in months that can have a multiple of 20 to 1. So companies began to attach to this playbook around the fact that they can create value very, very quickly and take the opportunity of the crisis of the pandemic to create tremendous opportunity and value creation for companies. So this phase of reconfiguring business is where we are right now, where companies are really considering all kinds of things that are changing to reconfigure the business. Finally, this is going to lead to a new age of next generation reporting. So we're moving quickly from static taxation to continuous taxation. At the same time, we saw last year, we are dealing with a climate crisis around the world. We have record droughts. The hydroelectric plants in China stopped. We have huge superstorms, fires, climate change, tremendous crisis, which has exacerbated inflation, of course. We have the Fed movement. We have asymmetry in the activity of banks between the Fed and the local central banks around the world. We have a trade war and a tech war with China and the United States. And so all these factors are creating tremendous disruption in our supply chains and our business models. We have a huge war that unfortunately, very tragically, is probably not going to be resolved anytime soon. Perhaps it's going to last as long as World War I or World War II, 4 years. Very, very tragic. So all of this is changing. But the thing that is not changing is that transformation as a trend is accelerating and digitization continues to accelerate. So companies are investing more and more in digitization as the only solution for this dramatic change. So basically, that's the only thing the companies can do. On top of everything else, we have a transition to the international tax regime. This is the biggest transition we had in over 100 years. We have Pillar 2, we have the book minimum tax, we have US international tax rules, we have foreign tax analysis, and unfortunately, this sequence of implementation is going to be quite chaotic. I'll tell you the truth, it'll be difficult. And it has a lot of risks. There will be management disruptions, there'll be risk of double taxation. And so it doesn't look really nice for the next 2 or 3 years. It's a challenge and we have to take it seriously. Fundamental to everything you're going to hear over the coming years is going to be that the implementation of the arm's length standard is very important. Is the pillar underlining the new tax reform system for Pillar 1 and Pillar 2 to avoid distortion, to make sure that the transactions, services, tangibles, intangible property, capital goods. And again, I mentioned the third industrial revolution because in the old days, the value chain was around agriculture and creating tremendous amount of value. Then industrialization, manufacturing, service models became incredibly valuable in the last 30 years. And now we're in the age of IP. It's all about intellectual property and the value of patents and trademarks, software, know-how, trade secrets, business models, and that's what's going to continue to create tremendous amount of value at arm's length in the world. And so on top of everything else, the challenge again is that we're entering, make no mistake, a new era of tax increases and enforcements all around the world. The Biden administration, what we call the Biden IRS, the new commissioner had just been approved by the Congress in the United States. They have a very ambitious plan to collect $80 billion in additional tax through this modernization program. And there's many tax administration's actions, including digitization, as I was saying, of tax enforcement all around the world. So it is a challenge, but what concerns us the most is what our clients think. That's the most important central point for us, is what do you think? So we've done a number of surveys, and 84% of you have said that all these business changes are accelerating transformation. That the businesses are focusing on transformation as the only solution to adapt to these forces, to these market forces. 2/3 of our clients, you have told us, that are focused on improving the supply chain resiliency and moving again from super efficient supply chains to resilient supply chain models. 55% are increasing investments in digital transformation in the next 12 months. Again, there's not enough tax professionals to focus on the tasks. I'm very, very privileged to lead, as Durval said, our global transparency network, which is composed of 5,000 professionals. We have engineers, we have data scientists, we have economists, we have MBAs, we have accountants, we have tax advisors, and data and technology and process is going to be really, really important as we consider some of these operating models. 1/3 of our clients are saying that tax policy changes pose a serious risk to their company, and a big percentage say that the timing of this implementation is of key concern. On top of everything else, like I said before, the world will have to redesign itself in the next 10 years because we're dealing with ESG, the forces of environment, social government. We have climate change. And the change is happening already, as you all know. In Europe, there's tremendous amount of rules and regulations around that. In the United States, we have the Inflationary Reduction Act. So the first time we have Europe, China, and the United States focusing on a green economy, and you have the regime change here in Brazil as well. So all these things is something that cannot be ignored. So we're going to have to address all these things at the same time. Now, we're very privileged to work with many private equity groups that are focusing on value creation. And transfer pricing in the arm's length standard can be a very, very powerful force for enterprise value creation. In the old days, private equity would buy a company and we restructure some of the elements of the company to create tremendous value, do that in 7 years, and then they started compressing it and do it in 4 years. Now they're doing it in 3 years. And this playbook is very well known among the best public companies in the world now. So many corporates are adopting these elements to redesign the creation of digital assets. They're creating digital assets for research and development, for manufacturing, for customer care, for sales. My sister works for a digital marketing company. Their goal is to replace all the traditional advertisers. So a lot of these digital advertising models are really, really important. At the same time, companies are considering ESG. And like I was saying before, this is about creating multiples. Companies, conglomerates, we have a lot of conglomerates in Brazil focusing on the portfolio configuration. So for the future, do we like our portfolio configuration? Should we get rid of some assets? Should we invest in other assets? Should we get rid of some elements, or should we invest in new capabilities, some new skills, some new technology that we need going forward to ensure success? So again, transfer pricing is a phenomenal opportunity to create value in the value chain working with others. Many companies are experiencing these triggers today. There's a trigger and there's a focus for change, again, because you're reviewing the portfolio, because you're making a new investment, because you're going to a new market, because you're buying a business or selling a business. Is there a deal? There's a lot of catalysts that are triggering these types of projects all around the world. And the potential benefits, like I said, is a streamlined model. This is a huge opportunity to simplify things. We have very, very complex businesses in Brazil and around the world. We have very, very complex regulations. So there's a huge opportunity to simplify things from a people perspective, from a technology perspective. We know the workforce have changed probably forever. In New York City, we have the new normal. It's about 60% occupancy on our buildings in Manhattan. And so it's about 3 days a week. There's all these different changes that are occurring. And there's a tremendous opportunity, again, to create value. From a tax perspective, obviously the taxes is actually the number one cost for every multinational company around the world, more so than cost of goods sold, more so than personnel costs. And so the tax optimization of this is really important, and transfer pricing has to work together with international tax, with indirect tax, to understand the tax attributes of our companies, how our overall effective tax rate is being impacted. And of course, US multinational companies, for example, have to consider a number of concepts in the US international tax law around GILTI and BEAT, credits, and making sure that we can utilize those credits and those tax attributes to avoid double taxation and optimize our positions. So value creation starts with the business, starts with focusing on the future, but then at the same time, we have to focus on how do we solve these problems from a tax perspective across all these areas. Now, Brazil is a tremendous opportunity. We've done so many projects over the years with our team here together. And Brazil has a very interesting economy, and obviously an enormous economy, very diversified, many different sectors. And as you would expect, the solutions are going to be very, very tailored to your industries, to your particular circumstances. A tremendous trade with Europe, with North America, with a number of partners, and tremendous amount of growth. So this is very likely to create tremendous opportunities for foreign direct investment, technology transfers, and other opportunities. And so getting into the concepts of the arm's length standard, the arm's length standard is very important. The first is to recognize that there's a requirement to achieve an intercompany result, to make sure that the number you have in your tax return is consistent with what other third parties would have achieved under common facts and circumstances, similar facts and circumstances. And so we don't have to create a fiction. We just have to make sure that we understand our facts in our model and then determine what is that operating income and what is that result that we're going to have. It's important is the intercompany result. Sometimes we have differences between the method that we use to evaluate the transfer pricing policy and the method that we use to test the result. To test the result at the end of the year, say for this fiscal year, what is my method, what is my result? Do I fall within this arm's length range? The arm's length range, importantly, is not a range that is determined by the government, like historically has happened in Brazil, but it's a range based on either transactional comparables or comparable companies that have circumstances. The key six elements are very important. You're going to hear a lot about that. One of them is the characteristics of the operations. How capital intensive am I? If I am very capital intensive, all things equal, I would expect a higher return. If I don't use capital, then maybe I don't need a return for the capital. Am I a distributor? Are you a buy-sell? Are you a trading operation? Are you an agency? Are you a service provider? What are the functions, risks, and assets that become really important? Contractual terms is very important. The arm's length standard respects the good business judgment doctrine, which means that you as a multinational company gets to decide how do you want to allocate your functions and risks around the group. You know how to run the business better, and the idea of it is that governments must respect that as long as the substance is in line with your form. So basically, you can decide how do you have those contractual arrangements. You can choose, I want to have a lot of risk and a lot of functions, or I have very little risk and very little functions. You put in place an intercompany contract, and if the behavior of the parties is consistent with that contract, then tax authorities should respect those arrangements. Economic circumstances have to be taken into account too. Am I dealing with a recession? Is the dollar increasing? Is the foreign exchange rate impacting the intercompany results that I have? Do I have a supply chain disruption? All of a sudden my costs went up 100%. How do I allocate that cost between my related parties? What's the business strategy of my group? You need to understand that. Am I pursuing a market preservation? Am I focused on a market penetration strategy? Who is bearing that risk? Who's going to own that market potential? Who is developing intangible property? Again, intangible property in the fourth industrial revolution becomes the most important factor. Not only who is paying for the intangible development costs, but also who is managing what we call the DMP functions, the development, the enhancement, the maintenance, the protection, and the ultimate exploitation of the intangible property. So we have to have alignment between the capital, who's bearing the risk from a capital perspective, and then who's managing it from a people perspective. We have more than probably 140 countries with transfer pricing rules around the world, so it's difficult, very difficult to generalize. But in general, I would say that most countries have these requirements. They have three basic requirements. Like I said, the arm's length standard, the arm's length requirement. Most countries have this contemporaneous documentation requirement. As part of the BEPS Action 13 program, they have a master file requirement to describe the operations globally for the companies. They have a local file requirement to describe the specific intercompany transactions impacting every particular country. They also have a country-by-country report they have to file to show exactly how many employees they have and how much profits they have per country. And then finally, many countries in Latin America, is very most popular, is they have information returns to make sure that that you disclose your imports and exports, service transactions. In some countries like the United States, we have $10,000 penalties for every single transaction. If you make a mistake in your form, they charge you $10,000. Many multinational groups have a lot of transactions. On top of that, many countries have understatement of income penalties. In some cases, penalties can go up to 100% in some countries. Obviously, we're now dealing with high interest rates, so tax authorities also charge interest rates. So you have interest, you have adjustments, you have penalties, and all these interest and penalties, of course, are not recoverable, even if you have a tax treaty. So there's a significant risk of getting it right. As part of Pillar 2, there's going to be really not a lot of opportunity to make adjustments after year end. So there's a tremendous amount of pressure for us to get the right intercompany result during the year, because to be able to make those retroactive adjustments is going to be very difficult and unfortunately very costly. Other governments like Argentina has the Declaración Jurada or Dictamen Fiscal in Mexico. They have certain requirements for the statutory auditors to make sure that they're confirming that taxpayers are complying with all of their legal and tax obligations. So like I was saying before, the arm's length standard focuses on these 6 factors. We cannot figure out what our new transfer pricing policy is going to be unless we really know what is our IP. And by the way, you can have routine intellectual property that doesn't derive any excess profits, or you can have something that is really unique and extraordinarily valuable. You can have a secret formula, you can have a biotechnology, you can have a piece of software, you can have something extraordinarily valuable. You can have somebody, if you have a license for using Excel, it's not going to give you a big advantage because it's commercially available, because everybody has it. So there's a lot of routine intangibles that are not necessarily going to factor and attract a lot of economic rents. So where we're interested is, what is the IP that's going to create excess profits over time, be able to identify that, and identify what are the intangible development costs behind them. Like we said, we have functions, risk, contractual terms, with economic conditions, and it's this new analysis to working with the business people to understand the financial forecast, to understand supply chain, to understand how actually we make money as a business, that's going to determine how do you allocate your income in Brazil or around the world with your affiliates. As you know, the Brazilian income tax law over the past few years had it was very logical, rational focus on simplification, make it predictable, make it certain, here are the margins. And the Brazilian income tax law said, you taxpayer, please choose the method that provides the best result and make sense in terms of trying to keep it simple, having prescriptive rules. But these margins were fixed. And so sometimes it didn't fit necessarily with the new operating model. And it definitely ignored business strategies, ignored intellectual property, involved DMP functions, decision-making, functional analysis. And so sometimes it created significant risk for double taxation because it was difficult to allocate profits one way or the other. And like I said, the arm's length standard is quite different because it incorporates life cycles, industry cycles, product life cycles, facts and circumstances. The global economy is changing faster than ever before, so there's a tremendous amount of opportunity to change things and modify things to make them adaptable and have more flexible and agile results. They can change from time to time. The adoption of the arm's length standard for many companies is going to help them use credits in different ways, because sometimes we create issues of not being able to use those foreign tax credits, and then we suffer double taxation. So by adopting the arm's length standard, it's going to help in terms of cost recovery requirements, the attribution requirements of withholding tax on royalty payments, and the reattribution asset rules. So there's going to be a lot of benefits depending on how the rules. Romero's going to walk us through some of those key elements in a moment in terms of how that's going to play out, but more to see in the future. So where does that leave us? And again, we're not going to get into the specific things that are changing because that's the next segment. We're going to be focusing on what is actually changing. But I will leave you with this, that I think we have a huge opportunity to elevate the tax function to a total different role that we've never seen in Brazil, because we'll have to be able to deal with the C-suite. We'll have to understand the financial forecast of the group. We have to understand the business strategies. What are we doing with digital assets? Maybe nothing, maybe a lot. What are we doing with ESG? Maybe nothing, maybe a lot. What are the futures of what are we doing? What's our cost structure in terms of procurement, cost of goods sold, raw materials, our people costs? And so it's very important. We can do it quickly, but we have to move quickly because the time is very, very short, to conduct an in-depth functional analysis of the current transactions. What are the business strategies and what are the economic conditions? We may be losing money because, quite frankly, globally, the supply and demand are still out of sync. China is still shut down, is barely opening. So we see big patterns and big changes in supply and demand across the world. And some of those forces, a lot of what we do in transfer pricing is to be able to differentiate what's driven by the external factors, supply and demand have nothing to do with the transfer pricing policy, and what's driven by our policies, internal transfer pricing policies. So that's why the industry analysis is very, very important. And we spend about $10 million a year just on making sure we have the best electronic databases in the world to be able to do that analysis in a very automated way, very, very fast, to collect that information and then interpret. Our intercompany results are driven by external factors or internal factors. Number two, we need to work to identify those major intercompany transactions, compare against the Brazilian income tax method from last year and in the past, to analyze that and see what are the differences, what are the outcomes that we would expect with that, and analyze those methods against other rules, because like I said before, this is a very holistic analysis. So we need to consider VAT, indirect tax, and other factors. We have to understand the tax attributes of our affiliates. What are net operating losses in some countries? What are our tax credits? How can we use that and model that? And we're going to talk a lot about modeling in terms of how do we do that to model what is our effective tax rate. Because unfortunately, most companies that I've seen around the world are looking at tax rates between 10 and 15% higher, unless you take action right now in terms of being able to analyze things quickly and come up with a plan to adapt to that process. Also, we have to consider the Brazilian foreign tax attributes is going to be really, really important. As Durval said, for sure, the models in Brazil are going to be very different than anywhere else in the world, and they have to be very tailored and very customized. Ultimately, this is going to get us to a decision. Are our model fit for purpose? Do we need a big business restructuring? Do we need to value IP, sell it, migrate it, cost share it? Do I need to change my sales model? Do I need a limited risk distributor or a commission agent? Maybe we don't. Maybe we need to just do some minor tailoring and modifications, a few transactions. We don't have to reinvent the wheel. And certainly we always try to do what I call minimal invasive surgery, just try to fix whatever needs to fix. We don't have to build a new rocket. We could just focus on what is it, the key parts and the components we need to modify. And maybe your model is fine, and maybe you will produce good results and sustainable for over 3 or 4 years, and then maybe you don't have to do too much. But that's the exercise that we need to do right away to come to a conclusion very, very soon. So in conclusion, thank you very much for your time. I think there's a number of opportunities. The most important thing you have is your time. Please do not procrastinate, because there's a lot of new information that has to be incorporated. This is a golden opportunity to elevate the tax function, to talk to the tax strategy, finance, the business stakeholders, to understand all the elements that will determine a sustainable and effective transfer pricing policy that can be focused, that can be ESG resilient, that you don't have to change for the next 10 years. There's going to be digital advantage. You can take advantage of the digital assets that you're building today. What's the role that those digital assets are going to play in explaining your transfer pricing? And that it's tax efficient, and that we don't create double, triple taxation. It's going to be really, really important. Data, for 3 years, I had the privilege of also leading the innovation and digitization at PwC in the US. And so we really got into the data, into the tax taxonomy of the data attributes that we need to solve all this. To be able to use automation, to be able to use artificial intelligence, we need to have the data in a particular format. So you have to become data savvy, and we need basically 3 things. We need the data, we have the technology, and then we have to create the user case. The user case is the element of how we're going to use that data to extract that information quickly and operationalize our transfer pricing. So it's going to be really important that we have good data. If we have bad data, our transfer pricing policies are going to be wrong. We have to have good data. And the good news is that the entire tax system around the world is moving towards the ultimate truth. And what's the ultimate truth? There's a lot of cynicism in tax authorities. They don't believe sometimes what the taxpayers say, or maybe what the advisor says. But the ultimate truth is data source. What is the data source? If I can prove that my data is good and reliable straight from the ERP system or from customs, and I can trace it and map it, then it's very, very powerful. So ultimately what we want is alignment between the accounting policy, the data, the transfer pricing policy, the intercompany contracts, to create effective transfer pricing documentation. And what is true after all these years is that the taxpayers that have this alignment, who control their facts and their data, have excellent results and can sustain the transfer pricing and make it a source of competitive advantage. And unfortunately, companies that don't have the data, they have inconsistencies, that accounting contradicts the intercompany contracts, those are easy targets for tax adjustments, for double taxation, for penalties. And so that is what's going to drive the quality of results long term, effective implementation. If you have effective implementation, documentation will be easy in terms of being able to document our processes. And again, the imminent trend around the corner is digital tax administration transformation, continuous taxation, more information real time, and it will become really important. So ultimately, I think the good news is that it is a challenge. We don't like change, of course. It's very difficult, and it's not fun. But it's going to be a tremendous learning experience for all of us. It's a great personal opportunity for personal transformation, for the transformation of the tax function, to elevate the tax function, to adapt the new environment, and hopefully to make value creation a very important element of your business. So with that, I want to thank you very much for your attention.